We do begin, though, with our talk of the tape. The fate of this rally, which feels anything but a sure thing. How long can it keep going? Let's ask Eric Johnston of Cantor Fitzgerald. He is here with me at Post 9. It's good to see you again.
Thanks for having me.
Sat in that very chair. You made a big call on stocks. You said they're going to go up 8 to 10%, all in the month of May. Not 3 days later.
Sure.
You got cold feet, and you reversed it, only for stocks to take off and go up about 7% to this point. And now we're coming, obviously, to the end of May now. Why didn't you just stick to your conviction?
So I was about 2 weeks too early, which 2 weeks in this market can be problematic. And, you know, after 2 to 3 weeks, I realized that based on some of the information we were getting, including Target and other information that was out there, that the upside to a potential bounce was not as great as I previously thought. And if you don't have the reward there, especially with the backdrop of having a very negative overall view, I decided that, you know, the risk reward was not attractive enough to be long. And we have gotten the bounce. It came off of, you know, 3,800, and it's happening for all the reasons that we thought would happen, which was that institutional positioning was extremely stretched, right? Sentiment was very low, CTAs were short, and the inflation outlook is in fact getting better. And so all those things did lead to a bounce, but it came off of 3,800 as opposed to 4,100 when I was here, you know, 1 month ago.
You pulled a 180. I mean, in terms of sentiment too. Mm-hmm. You came on and reversed the call, and it was like, this market's messed up. So I am totally changing my view, and it sounds to me like you've gotten so much more negative in such a short period of time than you were when we last spoke.
Sure. So the backdrop right now for equities is very unfavorable, and I think that second quarter earnings season is going to be a big moment for this market. So earnings are going to come in July, potential for negative pre-announcements towards the end of June. But if you look at the backdrop for earnings, costs for companies are rising, inventories are rising, and sales real time are starting to slow. And so one of the things that's gone on is that with the supply chain getting better, that helps inflation, but that also actually increases inventory, makes goods more readily available, and it's hard to get margins, hard to increase pricing. When there's scarcity value, when you can't buy a car, you're willing to pay top dollar. And so the point is that for this earnings season, you have a number of dynamics. The consumer's slowing while expenses are still remaining high for companies. And then the other thing that's going on is that enterprise spending, I do expect to start to slow. You've seen some job cut announcement, job freeze announcements from corporations. That's not happening in isolation, where they're just going to hold down costs around hiring. They're clearly going to be reducing spending in other areas of their business, and so it's going to have a cascading effect throughout the economy. So, and when earnings turn lower, that's when markets really get hit. We saw that in 02 or 01. We saw that in 2008, that once estimates turn lower, that's when stock prices can really accelerate to the downside.
You just think that estimates are going to turn lower faster than you thought.
Yes.
It sounds like
that is accurate.
And by the way, Salesforce is imminent. As I told all of you, we're waiting on the numbers. As Eric is talking about enterprise spend, this company is going to give you a real world view right here and now on what they're seeing from an enterprise spending standpoint. Let's just take the rally for what it is as we talk about it as still continuing, even though we were obviously down today to end the month of May. I mean, even those who are the most bearish are saying, yeah, stocks can go up another 5%. Animal spirits can take over and lead the market higher. Does that seem reasonable to you, given even how negative you sound?
Sure, it does. I mean, is it possible that we go to 4,300? So another, call it 3-4% from here? That's possible. But in order to own equities, you have to feel like the reward is attractive enough. And if you go to S&P 4,300 as an example, that's 19 times earnings, which where the 10-year yield is right now is way too expensive. One of the things that I hear people talk about is that the earnings multiple for the S&P has contracted from 22 times from 17.5 times, which is true. But interest rates have gone, the 10-year has gone from 50 bips to 2.85%. The last time it was at 2.85% was 2018. The S&P multiple went as low as 14 times earnings, which would be, in this case, would be 3,200 on the S&P. So multiples really, from our perspective, have not come down. And that there is, as long as the 10-year is anywhere around these levels, there's certainly downside to multiples, and we think that will happen.